crypto sell off with the stock market. I have a big downside move coming later this year in the stock market. And that's going to be the catalyst to really take us to that 12, 13,000 marker on Bitcoin. And I actually think that Ethereum is very likely going to head down to this next target around $645.
Why exactly Ethereum didn't go up and in fact went down by a significant amount following the merge.
So I think the key here is to just understand what type of market we're in. When you're in a bear market, it takes a lot to get price to go up because people are scared, right? So, if you're in a bull market, you could have the tiniest bit of news and price will rip up. It could even be news that's not relevant. And we've seen stocks like GameStop, AMC. I mean, all these things just go to the moon. But the problem is we're in a bear market, and in a bear market, people really need value. They need to know that something is immediately changing, and the merge isn't doing that, right? Yes, long term, it's probably fantastic for Ethereum, but in the near term, what is everyone focusing on? The Federal Reserve, interest rates, the US dollar, the economy, and all of those things are just crushing risk assets right now. So it was kind of a no-brainer to me that you saw a kind of an early front-loaded run up a few months ago, and then it just kind of came right back in.
You said that Ethereum wouldn't go up just because of a fundamental change in the blockchain, but actually it would follow risk assets. Let's talk about risk assets at large first. I want to come back to Bitcoin specifically, but risk assets have been falling today. Just as we speak, the S&P 500 is down about 2.5%. The stock market, bear market, you were calling for, I think, another 20% decline a month ago, but people are calling for even more downside. What's changed? Anything changed in the narrative since last we spoke about a month ago?
Well, I mean, the narrative that has changed is the Fed has continued to be so hawkish. I mean, much more hawkish than even I thought they would be. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385, so 3,385 on the S&P 500.
The Federal Reserve raised by 75 basis points only. I stress only. I mean, it's a pretty big jump, but only because there was a slight probability that there was an 18% chance of 100 basis points. That's what the Fed Watch tool was telling us. So it was more or less telegraphed. So yes, they are hawkish, but I'm wondering why the markets are still reacting as negatively even 2 days after the Fed meeting.
You're right. 75 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things is like, it's one thing to say, oh, if we go into recession, the Fed can save the day by coming in and, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a protracted, a long-term bear market?
Let's just take a look at what happened this year. Since the beginning of the year, it's gone up at least 200 basis points. All right, at the beginning of, as of last year, exactly a year ago, it was only at 1.48%. Do you think that the 10-year would have gone up to current levels had the Fed not been as hawkish as we've seen? In other words, had the Fed done nothing, would the bond market still have performed as poorly given the outlook on the economy?
My thinking is that the bond market would have pushed rates up. In fact, even before the Fed started raising rates, the bond market had pushed rates up. But I don't think that the bond market would have gone to this extent. I think the bond market, which is a smart market, it's known as the biggest market, it's the smartest market, they see that you want to let the economy digest these rate hikes. And I think that's the major issue here, is that the Fed is doing them one after the other, 75, 75, and you're not giving time for it to cycle into the economy.
So let's revisit your Ethereum call first.
First target is going to be back. So we are at a little bit of support per the chart. So you can see we bounced off these pivots right here. All right. And that's going to be a short-term little bounce. And then eventually we're heading back to basically just below 1,000, the double bottom. And then if I'm right that Bitcoin is headed to 12 to 13,000 and maybe even below, then I got to think that Ethereum could easily be headed down to 700, 600 area.
And that's going to coincide with the 3,700 S&P?
Yeah, so I think probably the 900 to 1,000 is the 3,700, and then the next leg lower in the S&P takes you down to that 600 to 700 level on Ethereum.
I see. And for Bitcoin, let's take a look at your Bitcoin.
Yeah, so you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin. To be fair, I know enough from my career to know that I don't pick exact lows. Yeah. And so basically in the teens, I'll be already starting to accumulate all the way down below. So basically, you see 16,000, I'll pick up a tiny bit, 13, I'll pick up a little bit more, 10, all the way down there. And the idea there is, I do believe that eventually Bitcoin's 100,000, 500,000. And so I'm not going to try to pick a bottom and miss it. Instead, I'll just dollar cost average in this lower range to build that core position.
Did you buy with both hands and feet when it went to $20,000? You went on air a couple of times saying if it goes to $20,000 last year, you would buy with both hands and feet. Did you actually accumulate?
Yeah, I did. I did buy back down there. Absolutely. Yep, absolutely. So again, I don't know if it would be called with both hands and feet at that point, but I certainly did pick some up. That's the thing that investors need to understand, is that every time you get a new candle on the daily chart, it's a new piece of a puzzle. And a good technician is going to go and look and say, okay, does this change my thesis? Does this change anything? And really what we've seen is the Fed's gotten more hawkish. The economic outlook for me is even more bearish based on the Fed being more hawkish, and that you have to start lowering asset prices even more. I think you want to look for a Fed pivot. The Fed pivot will be positive in the near term for risk assets, including Bitcoin. And I think that's where you start to nibble, not go all in at that level, but instead just dip a toe in the water. If it drops a little bit more, do another toe, kind of do that. Because again, we just don't know, remember, Bitcoin's only been around for now 13 years. It's a baby of an asset, and we just don't have enough data to really know for sure how it's going to behave.